institutions, but not a lot has been said about the individual practitioner, the person at the end of the day making decisions, approval, rejection, decisions on credit that ultimately are the foundation of the health of the industry if they are done correctly. First thing to note is, as we think about the world today, is that post-crisis, it certainly has evolved and changed. You can see that regulatory changes have been implemented globally. I should note that this is, my topic is more of a global discussion than it is specific to India, so it gives you a bit of a best practices and global perspective. So those regulatory changes that have been implemented have triggered a series of policy changes and requirements within financial institutions, and those have created a need for a lot more information to be gathered by individuals, by the banks, by financial institutions. That information requirement has fed into a need for a substantial amount of systems and infrastructure to support that. And along the way, there's substantial more reporting, auditing, compliance requirements, a lot of forms to fill, a lot of process to follow. And so all these changes that have come about have made the role of a credit practitioner that much more challenging. The pressures are higher than they've ever been. As you can see, on the left-hand side is just a reminder of the risk management and compliance challenges that have arisen that create pressure on the individual, from learning new analytics, more rigorous analytics, to learning all these new systems and learning how to apply them, to understanding the implications of the policies that are being implemented and figuring out how to apply them, all under the intense scrutiny, or intensified scrutiny, I should say, of internal audit, external audit, and all sorts of other mechanisms to make sure that things are done according to policy. On the right-hand side is the other pressure that everyone in this world is experiencing in the financial services, and those are the commercial pressures. And one way or another, whether you're directly involved on the commercial side or not, you're feeling the pain of the expense management associated with companies having invested substantially in systems and infrastructure, and having to recover those, having to manage the costs in some fashion to remain profitable and successful. And so you also see pressure on the top line to make up for that higher expense. And then you also see a greater market share grab and effort than ever before, largely because there's a variety of reasons, but one of them being is that the financial crisis has actually reduced some of the profitable avenues that financial institutions have had to grow, and so they're trying to find new ways to grow, and a big part of that is grabbing share. So there's just an intensified effort around that. So the question is the credit practitioner of today prepared for this new world? Is there the right skill sets in place to support this changing environment, this new rigor, this new scrutiny, and that's a lot of what I'm going to be talking about. Apologize, there's a few cartoons in between if you're add some levity. Immediately post-crisis, there are a number of surveys that came out. One of the more respected ones, an organization called Risk Minds, and they surveyed risk managers about what they thought happened to cause the crisis and what should change. And if you see the two bullets there, you'll see the emphasis that they placed on training and on people. And again, it's a lot of talk has been about other areas, and a lot of change has been in other areas such as systems and information and infrastructure and incentive schemes and whatnot. There isn't a lot of talk about this particular topic that did come up as an important and influential factor that, as you see from the quote, was perceived as the number one area that needed change. So that was 2009, it's 2014, and the question is, how are we doing now? If this was flagged as an issue, are we performing, do we have the skills at the level to support the current requirements? Moody's Analytics is the sister company to the rating agency, is involved in risk management solutions, and we've been doing training and certification for many years, actually 40 years if you include now the Canadian Securities Institute and the Institute of Canadian Bankers that are now part of the organization. In the area of commercial credit certification, we've had the opportunity to run online testing programs, among other types of programs, and we've been doing it for enough years and for long enough time that we have a view and a benchmark of performance across markets, regions, functions, industries, and I'm going to share with you some findings about performance globally. This covers about 40 different countries, so it's pretty comprehensive. The test itself covers 4 different areas. You see the financial analysis portion, the management capabilities, risk mitigation, that's problem loans substantially, and the assessment of market and industry. And if you look at the average score globally, it's a passing score, 70% is a passing score. But the difference is, and the message really comes down to the subcategories as you break it down by segment. And I'm going to highlight the one area that seemed to be consistently weaker in global markets, and that's the core area of the technical financial analysis skills. You can see here that it's below average and below passing grade. Another view on the financial analysis section shows you a distribution. This is a cumulative distribution of scores. And I use that because it's important to show that 65% of the people that we that we tested, this is before taking any training or the final exam, this is the initial assessment, did not pass, and that's not good. When we further break down the financial analysis and capabilities associated with that. We see variance in performance by different category of content. Now we can do that for every one of the 4 segments and by lots of different cuts. I just picked a few. I just picked financial analysis and cash flow in this case as illustration. But you could see cash flow being a very weak area for people that have been through this assessment, and as all of you in this room probably are well aware of, cash flow analysis is pretty essential to doing good credit analysis, and so it's not a good sign that on a global basis that's the weakest area by far. I should note that this particular weakness is consistent. It's not. It doesn't vary. Now, performance does vary, obviously, by region, by country, but relatively speaking, well, actually, broadly speaking, cash flow weakness is something that we see across the board, which is something that really needs to be addressed. Again, running a distribution gives you just how problematic this is. This is, again, a cumulative distribution, and here you see 85% of the people that have been through this assessment did not pass it. It's 85% of people, and I want to mention again, this is 40 different countries, all regions. It's and different types of institutions, banks, asset management firms, different financial companies. So it's not a it's not an encouraging statement about capabilities in this area. We have I'll show you a few cuts, high-level cuts, just to give you a sense for the variance. So when we look at it by broad region, I haven't really broken it out by country. This is a lot of detail, but by broad region, you see the variance. You see how the Middle East and Latin America tend to perform weaker than average on the financial analysis section, you see the UK doing on average a little better. You start breaking it out by country, and you see you get much more insight into variance and areas of challenge. Also, you can look at it by function, and here really it's a message about experience and seniority. You see management tend to, spend more time, have more experience, they tend to do better. Credit analysts generally are more junior, people that are taking this exam, newer, doing a little not as well, audit people doing a little better. It varies. Back office operations, probably an area that organizations might want to look at to the extent that this presents a concern to them, which I think ought to. Interestingly, in this next cut, you don't see significant difference by type of financial institution. But I will tell you that as you dig into the details and you start breaking financial institutions like regions, into their subsegments and types of institutions, you start seeing more variance between those that specialize in certain areas like lending or development banks, or you do see variance, but at a high level, performance is consistent on that level. So in 2009, I showed you the risk managers all kind of felt that training and education and people were a big challenge that needed to be addressed, and showed you where we are now. The question is, how do we feel about where we are globally, and are we prepared for the next downturn? Have we taken the steps sufficient to shore up capabilities of financial credit professionals so that when the next set of hiccups, if I can call them hiccups, or meltdown, are they in a position to handle it more effectively? Or is this just, looking at the back, hindsight, and saying that's what happened, and then not taking sufficient steps? That's the question. As we do work around the world, we are seeing increasing focus in this area, which is encouraging. The work that we're doing with financial institutions in the area of risk culture, and in conjunction with a lot of systems and process implementation, is encouraging in that training is becoming more and more of or at least increasingly perceived as the foundation of an evolution of a risk culture of an organization. And we find that very encouraging, and my colleague here, Clive Humphrey, has been leading substantial overhauls or support of overhauls of major financial institutions around risk culture, which involves really a consistent set of messages and training and capabilities across the organization. We're also seeing providers of training and certification creating more options and more solutions for the market. And obviously, some of you guys here in the room have gone through the CCRA. This whole program is an example of one such credible success program that creates such an opportunity, and that's very encouraging, and we're seeing more and more of that. Lastly, we are seeing more regulators stepping in and setting proficiency standards. In many cases, I shouldn't say many, in some cases, they are building expectations and proficiency standards into their actual requirements and policies for financial professionals. So just as was discussed earlier about there's certification for a lot of areas, but what is there for the credit professional? We are seeing regulators and SROs, the self-regulatory organizations, taking steps, and in some markets it's becoming quite entrenched. So the question is about India. What is the current state of credit knowledge and capabilities in this market, and is this market prepared for the next set of challenges if and when they come? Well, I will tell you that we don't have enough data at this point from this market to give you an insight into capabilities here. We've run this program with a number of banks, but it's just not enough to feel confident to share it with you. But I will say that this is not an easy time for you folks, for folks in the industry, to be a credit professional, and in India. And similar to the slide I showed earlier, This is a time of increased problem loans. This is the time of greater competition. This is a time of greater exposure to international markets. This is a time when regulators and consequently financial institutions are instituting a lot of policies. They're aggressive, they're demanding, so it is not a, it is definitely the right environment for, for individuals, institutions, the market to reinforce, build, support the credit professional with more training, more capabilities. And as noted there, the most important thing right now for people in this industry, getting into the industry, is what many of you here are doing and what AIWMI and NISM have created is getting prepared, getting the right training, because things are probably not necessarily going to be easier. You got to be ready to take on the challenges, and I applaud those of you here that have been through the CCRA program and have taken the time to go through that. The note about the concept of establishing a systematic process of certification in the way that is being done here and needs to continue to be reinforced. It is it's not as straightforward as it may appear or sound. There's a lot of choices, decisions along the way that need to be made, and it's important to get that right. It's all the way from starting the concept of what is the right benchmark, what are the right competencies to emphasize for a credit professional, what should they know in this market, who's to say what it is. That's an important step. Once you've established that benchmark, that understanding, you have to figure out, well, where is it that there may be gaps relative to that benchmark? And that's an assessment to figure out how to create targeted programs